Good afternoon, traders. Today's Tuesday, July 2nd, 2013. We're here to talk to you about Friday's non-farm payroll number coming out at 7:30 Central. It's right after the holiday on the 4th, so it'll be coming out on July 5th. Not expecting too much activity. Friday is normal market trading hours, so everything will be open all day. But being that it's between the weekend and the holiday, July 4th, we'll see how market trades out here. The number they're expecting it to come out around 161,000 seems to be the consensus. Last month it was 176,000. The rate did jump to 7.6% unemployment. They're expecting this month for the rate to go down to 7.1%. We'll have to see how it comes out right now. Regardless, these numbers are pathetic. 161,000 jobs created in what's supposed to be a recovery right now. 171,000 created the month before. It's nowhere near where we need to be, and I think it's nowhere near where the Fed's going to back off any policy that they've been talking about. This past month, you did have this past last week, 2 weeks ago, you did have Chairman Bernanke of the Federal Reserve did talk about pulling back on the QE and pulling back on the bond buying. But in all reality, they did set that target of 6.5%, I think it was. And the only way where I think we're going to get to 6.5% in any time is if they you keep seeing the labor force participation rate declining. Otherwise, I think we're pretty much set that Fed policy will remain the same. What are you looking at here today for the equities? Oh, I'm coming to you today too with Tom Powers and John Kennedy. John's going to talk about the equity markets. Tom will talk about the bond markets. I'll touch base on the gold market. But so John, what are you looking at here with the equity markets? What are your thoughts for Friday?
Well, we've definitely made a recovery off the soft patch from about the third week of last month. Stocks have traded significantly higher since then. Data's been mixed, but for the most part in the positive. Yesterday we had ISM that was up 1.9 points, up above 50, which was good, but mixed in some of the sub-reports. Unemployment was down, the new orders was up. So it's really going to be leading in for the next coming days. What we get being a short holiday week, there is a lot of information as far as economic data. Today we had factory orders, which were up about 2.1%, which once again is a very positive sign. The automotive industry reported their sales today, and we're up across the board, which is a good sign from the manufacturing standpoint. A big thing, taking this jobs report, it's going to be a large factor in how the stocks trade here through the second half of the year. A big thing here currently in the shorter term is going to be the earnings. It has been revised down for the S&P 500 from about 6% to 2.5, but still positive. You see those numbers come in. I think it could more than make up for if we have a jobs report miss on Friday. Obviously, another factor, too, is the international scope. There have been, over the past couple of weeks, some worry about slowdown in China. Obviously, their demand figures impact the world of commodities and the stock market quite substantially here. So, if they can turn that around a little bit, and barring some kind of a renewed debt issue in Europe, I think there's room there for continued growth. As Bob mentioned, we're looking at consensus ranges from about 130,000 to 200,000, with the median right about 165. From a technical standpoint, over the past couple of days we've had some bullish, technical numbers that we can take going into that report, both longer term and shorter term. We've crossed both the 9-day and the 60-day moving average, which is positive. We have momentum studies that are continuing to move up. If we are able to break through some of the technical levels, beginning right around 1620 and then above that at 1633, if we're able to get a good number and get through those momentum studies will continue to rise, and we could see continue to move higher. On the downside, we're looking at about 1592. So we go into that report, and if things turn out well, we should have some room to go to the upside.
Well, 1633, you're absolutely right. I mean, 1640 looks into that inevitably. If you turn off all the outside noise on these markets right now and just look at those technicals, it looks like we're going to see a move to back to 1640 after it bounced off those mid-15 level ranges we saw after Bernanke. But yeah, I mean, turn off the noise and look at the Fed. I mean, just all eyes on Fed. I think this job number point is mute for the equities, being that the Fed's not going to change their policy until unemployment gets to a certain rate, which I don't think, you're not going to see it in one report. You're not going to see it at any point this time this year. So all eyes on Fed. Stocks look bullish, 1640, but you got to turn off the outside noise. I know right now the market, if you start looking at some, outside factors, it does look soft, but yeah, 1640 looks like it's probably where it's going to go, 1633. And from there, I think then you look to play downside from there, just to see how it reacts up there. Tom, what about you on the bonds?
I agree with you guys. I mean, I don't see any major policy changes taking place until we hit 6.5 or even 7% unemployment. I think traders are overzealous. I think they're too eager to short the bond market and anticipate a possible end of QE. Like we had said Bernanke said last month, no major changes until we're at that 7% rate. And we really need to be adding 175 to 200,000 jobs every month.
I think it's more than that.
It might even be more than that for
I think
a year to get
you got to be averaging. I think it's about 350 actually, or 4. I think is what I remember reading to get to that level, to even get to 6.5.
To even get to that number, yeah.
And that's not. We could get there though. We could get there real easy if you keep seeing workforce participation drop. Which,
well, that's a big thing. I mean, you're looking at.
I think realistically,
we're
probably higher. I think it's safe to say that we're higher than 7.6 on the employment range. But
well, you have baby boomers retiring, and the economy's still only expanding at about 2% annual, which is not very good. I mean, 7% unemployment's good, but not. It's good for 2% growth, but not. We're not seeing the economy continuing to expand the way that it should. One negative consequence of 7% unemployment is the end of QE and possible higher interest rates as well. And I don't think anybody really fully anticipated the 30-year mortgage rate to jump a full point in the last month. The Fed's going to need to do whatever it takes to keep mortgage rates artificially low, I think, and avoid damaging the housing recovery. I think that could be a big drag on the economy going forward. And they should keep rates low. I would expect increased volatility in the bond market over the next few months, so I think I wouldn't be surprised to see bond futures rally back up into the low 140s and play a trading range down into the low 130s on the 30-year.
Yeah, there's definitely, I think, a range-bound trade developing there.
Yeah.
Usually in these range-bound trades, you like to use options to play it, but I think you might be a little risky, being selling premium with, strangling the market. But I think that might be a little risky even in this environment with the Fed or with comments that could come out. For the metals, I don't think metals right now are definitely. If you're a bull, you're not looking good. If you're a bear, you're loving this move right now. And I think this downside move in the short term is going to continue probably through the end of this month through July, which typically is not a great time. Actually, going into August as well, not a great time for the metal markets historically from a seasonality trade. So I think right now, if you're a bull, you just got to kind of lie and wait here. I do anticipate, like I've said before, metals will make moves higher. In the quarter 4 of this year. But in the short term right now, it does appear to be under pressure. I think what you got to do is go with the trend, and the trend looks to be down still. I think the trading ranges are going to tighten up. I don't think you'll still see in gold those dramatic moves like we saw, $80 to $100 down days. I think it will kind of tighten itself up a little bit. The volatility will probably ease out a little bit, but I'm not right now looking at these. Yesterday we had a rally. We had a rally on Friday in silver and gold. I think beware right now with these rallies that are coming in. They could catch some of the bulls up here, where people trying to buy in on strength, and then actually the pullbacks, I think, will be dramatic. Right now, be careful with that. If anything, I like getting short on some of these rallies and playing that trade for now. But again, long term, there are plays you can initiate right now where options are pretty cheap here out in February of next year and March of this year. If you have any questions, you can always call myself at my trade desk. If you have questions about the bond markets, feel free to call Tom at his trade desk. And if you'd have a question about the equities, feel free to give John a call at his trade desk. But as for the number Friday, we're not anticipating too much, being the holiday that it is, and I think the market's open for the full day just because of the fact that we have the jobs number coming out on the day after the 4th. But see how it plays out. I think next week you'll probably get some more moves once the 4th of July holiday passes by. Remember to follow us on Facebook and on Twitter. And remember, futures trading does pose a significant risk, is not suitable for all investors.